Welcome to the Credit Compass, helping you navigate the world of European credit. We break down the biggest moves in credit markets, macro trends, and the fixed income strategies shaping Europe and the UK's financial landscape. In today's episode, we're zeroing in on corporate earnings and, crucially, what CEOs and CFOs are saying about the quarters ahead. As geopolitical and market volatility intensifies, many companies are adopting a more defensive posture, and that's having real implications for capital markets, investment appetite, and earnings trajectories. We'll dive into sector-specific results, executive insights, and the macro headwinds shaping corporate strategy. All right, let's dig in. First up, Germany. The federal government has cut its growth forecast for the year, now projecting economic stagnation rather than the modest 0.3% growth previously expected. That's according to the newspaper Handelsblatt, and it's largely due to anticipated industrial fallout from the newly imposed U.S. tariffs, despite Berlin's plans for fiscal stimulus. Globally, the International Monetary Fund has also trimmed its growth projections. World output growth is now expected to hit just 2.8% in 2025, the slowest pace since the 2020 pandemic. Next year's forecast is similarly down to 3%, a 30 basis point drop with risks skewed decisively to the downside. So how is that feeding into sentiment? According to Morgan Stanley Strategist, the European Q1 earnings season has started on shaky ground. They expect a few companies to beat their estimates, but a growing number to miss consensus estimates across the remainder of this first quarter earnings season. Further, they expect estimates for the quarters ahead to continue to fall on the back of a slowdown in the US and foreign exchange headwinds. But amid this gloom, there are still some green shoots. Investors are turning their gaze towards Europe, citing both opportunity and resilience. Larry Fink of BlackRock, speaking on his firm's first quarter results call last week, suggested that Europe may emerge as a more attractive destination for global capital, particularly as funds begin reallocating away from the US. This sentiment is echoed by other investment managers who see relative undervaluation and greater medium-term corporate stability in European markets. The comparative stability of indices like Germany's DAX, up over 5% this year, further underscores Europe's growing appeal. Fund managers are responding with notable optimism. Surveys indicate a rotation towards European equities. According to the most recent Bank of America European Fund Manager Survey, over a fifth of global managers are now overweight the region and a marked pullback from U.S. stocks, the highest level in almost 2 years. This shift is reinforced by substantial outflows from U.S. equity ETFs, exceeding even those seen during the onset of COVID-19. Analysts highlight several advantages for Europe, including its relative undervaluation, economic resilience, and potential productivity gains from adopting emerging technologies like artificial intelligence. The combination of geopolitical agility, strong corporate fundamentals, and favorable valuation metrics positions Europe as an increasingly attractive environment for investment capital in the evolving global landscape. Let's now turn to the companies themselves. While we're still early in the reporting cycle, several major names are already shedding light on their expectations. The cosmetics giant L'Oréal beat expectations with 3.5% like-for-like sales growth in Q1, led by strong demand across Europe. CEO Nicholas Hieronymus acknowledged better-than-feared performance in China and Europe, which offsets softness in North America. While tariffs may pressure margins later this year, the company has pricing strategies in place and expects full-year sales and profit growth to accelerate. Initially dismissive of tariff risks, Heineken has since flagged growing concerns over supply chain disruptions. Still, they've reaffirmed their full-year guidance, projecting organic operating profit growth between 4% and 8%. A French auto parts supplier, Forvia Automotive, has navigated geopolitical risks relatively skillfully. CEO Martin Fischer revealed that Forvia has offset about half of its exposure to the U.S. tariffs on Mexican imports through proactive renegotiations, and supply chain adaptations. The result? 2.6% sales growth in Q1, outperforming the broader automotive sector. Nordea, the Nordic bank and largest European bank to report so far, noted a shift in consumer and corporate behavior. Households are saving more, while companies are focused on liquidity and balance sheet strength. Despite the more cautious tone, credit quality remains robust with low provisions and increased savings activity year over year. On the flip side, Bunzl, a FTSE 100 supplier of business essentials, issued a surprise profit warning. Tariff pressure and operational issues in North America, which drives 60% of its revenue, were to blame. The result? Share buybacks were suspended and the stock fell over 25%, a stark reminder of the risks exposure to the U.S. can pose in the current environment. So what does all this mean for credit investors? The impact of tariffs, while uneven across sectors, raises serious questions about firms' ability to hit earnings and leverage targets. For highly levered borrowers, this spells trouble. In our view, it remains especially important to think about the impact tariffs could have on a firm held within your portfolio. While the goalposts appear to be in perpetual movement, for some firms, the risk of missing targets remains very high. In market terms, this means that the movement in spreads and yields presents a further challenge, particularly for more highly levered borrowers. We expect lenders will take a more aggressively conservative approach to their lending terms and will scrutinize a firm more thoroughly. As a result, timelines for transactions are likely to be extended, and the issuance pipeline has already slowed. There will be pockets where issuance will surge, but broadly speaking, yields remain reasonable on a historical basis for borrowers. In plain terms, lenders are broadly more nervous and spreads are beginning to reflect that. Deloitte's recent CFO surveys across Europe and the UK are particularly revealing. In the UK, even before the April 2nd tariff announcement, CFOs were sounding alarm bells over US economic weakness and geopolitical instability. Margin pressure, energy costs, and inflation topped the list of concerns. Across Central Europe, the tone is slightly more upbeat. Executives there expect lower inflation, stable growth, and are prioritizing cost control, digital investments, and risk management as 2025 unfolds. So where does that leave us? There's a real opportunity for Europe to emerge as a magnet for global capital. Private markets should be a large beneficiary of this in Europe. The building blocks are there: attractive valuations, sound fundamentals, and a geopolitical landscape that, while far from stable, feels more in Europe's favor than ever. But execution will be key. If the EU is serious about anchoring long-term investment flows, it needs to follow through on calls for a fully realized savings and investment union, and both Europe and the UK need to finalize capital markets reforms that have long been in limbo. As always, we'll be watching closely, particularly as more European and UK banks begin to report. Their tone will be crucial in understanding how the broader market sees the path forward. That's all for this edition of the Credit Compass. Don't forget to like, subscribe, and share the podcast with colleagues and friends. For more on credit ratings and our in-depth financial research, please visit us at KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.